And I think that's what's important to focus on. And that is really kind of the driving factor in having some exposure to that.
So Ren, what I'm hearing here is that you really can't approach any one of these ideas, any one of these innovation platforms, any one of the funds sort of in a vacuum. You really have to think about it all the way through that portfolio construction process so that you're figuring out how it helps the whole portfolio, not just the one thing you're investing in, right?
I think that's an excellent summary, Dave. Hi, I'm Ren Leggi, Client Portfolio Manager with ARK Invest. On this season of The Switch, we're going to address how innovation performs in times of market turmoil. As always, we'll be joined by ETF Trends to facilitate the discussion and make sure we don't leave anything unanswered. So let's get the conversation started by talking about volatility and how it's not a bad word. Dave, what do you think about that?
I actually think volatility is a very good word. I mean, try to imagine a world where there was no volatility. You couldn't actually put together useful for portfolios. I think it's important to have things that move in opposite directions all the time in, pretty unpredictable fashions. And that means volatility. That's how you build world-class portfolios.
And Ren, when we talk about volatility, and especially pertaining to ARK, it's embedded. It's something that we all have to live with if we're going to participate in the companies of the future, for sure. How do you look at volatility, and what role does it play?
No, that's certainly true, Tom. I heard that you are a very skilled dancer, so I think this phrase will resonate with you. It takes two to tango. So it's not just volatility, it's also correlation, right? So the bigger the difference, the more the portfolio is diversified. And I think that's key, right? When you look at how investors kind of allocate across asset classes, it has to be dynamic, right? It has to provide portfolio diversification. And if you look at these asset classes, we're starting to see that this is more than just a style of investing. This could be its own asset class, not only because of the volatility, but also because of the correlation to those other sub-asset classes, right? So when you look at these individual technologies in isolation, the correlations between and among them are quite low. We did a study where we looked, and again, we did this pre-pandemic and post-pandemic, right? And we saw that the correlations between and among the 14 transformational technologies that we've been researching was around 0.22 correlation on average, pre-pandemic levels. That has increased slightly to 0.32, but if you think about that number, it's actually quite low. When you compare it to the correlations between and among, just industries and sectors within the S&P 500, which was on an average of 0.55 pre-pandemic and then 0.73 post-pandemic. So correlation has increased within kind of larger cap stocks. So when we think about innovation and providing diversification and acting as a new asset class, this kind of validates kind of some of the assumptions that we're making.
That issue of sort of trying to figure out how to get more uncorrelated performance out of the equity market, that's not a new idea by itself. A lot of folks have looked at ways of tilting their exposure either, towards momentum or quality or some factor. Should we think about innovation as just a way to tilt a portfolio, or do you think these are just fundamentally have to be different asset classes and different pools of assets that you can't tilt a big index towards?
I think you have to think about it as kind of a separate asset class, because it is, when you think about innovation and disrupting existing industries, it's primarily going after some of these value-oriented kind of styles, right? Or industries, I should say. Right. So when you think about kind of industries like fossil fuel based energy, right, that's been around for a century, but we don't think it may be, and it's becoming more and more vulnerable to disruption. So this kind of sets a new kind of category within that growth bucket where it can be creating tremendous amount of value, but also disintermediating existing industries.
Ren, when you look at the flows this year into ETFs, it's another record breaker. However, where most of the money is going into traditional core-based ETFs with the legacy indexes, cap-weighted indexes, and they have a very small allocation towards innovation. So why is that, and why do we continue to see a lion's share allocated toward your father's indexes?
Yes, I mean, I think it goes back to how these indices are constructed, right? There's metrics, they're rules based, right? Whether it's market cap weighted or if they're requiring maybe a certain length of trading. That's the case with, say, a NASDAQ. So you're actually missing out on some of these newer companies that are coming to market. And we've seen a surge in the number of IPOs, direct listings, and even now SPACs. And there's a lot of innovative companies that are coming to market. And so, we're not saying all of them are investable, right? Or all of them are attractive to us, but there are many that are coming through and making their way into our portfolios. And you wouldn't see them in some of these indices, right? So it takes a long time for some of these companies to make their way into an S&P 500. By that time, they could be too mature, and maybe the upside, we're trying to achieve in our strategies 15% annualized return over a 5-year period, right? So, by that time it could be too late. So we're trying to provide kind of that exposure to these companies that have that growth potential over a long period of time. And we've seen that when we looked at these portfolios compared to broader based, even the technology sector we get compared a lot to, right? The overlap is very low, right? And I think that's because innovation really goes beyond the technology sector. It really does kind of impact all industries and sectors.
One of the things that has been really, I think, a hallmark of this year, 2021, in the markets has just been the crazy spikes of volatility we've seen, right? If you measure by VIX, we've gone, VIX in the 20s, VIX in the low teens, back and forth on almost a daily basis. And that sort of whipsaw behavior, I think, has made people really scared of volatile markets, thinking that somehow means they're going to lose money. How do you talk to investors about that difference between just the standard deviation of a portfolio and your actual portfolio risk?
No, I think that's a great question, Dave. What I relate it back to, I go back to the 1980s, right? I remember it clear as day. I was just graduating college. I know Tom was, transitioning from preschool to kindergarten, but emerging markets, right? When you think about in the late 80s, what happened, a lot of investors are starting to explore this as kind of a new asset class. That wasn't an asset class at the time, right? But it evolved, making up 13% of the global equity market cap. And now it's 60% of the global GDP. If you look at purchasing, the purchasing power parity. Back then, if you look at the late 80s, these emerging markets, when you looked at them in isolation, were very volatile. And that scared a lot of investors that were considering them at the time. I mean, they were associated with, geopolitical uncertainties. You had corporate governance issues. You had liquidity issues. And I think that some of those actually will translate and are similar to what's happening when it comes to these technologies, right? I mentioned that, if you look at some of these technologies in isolation, they can be very volatile. But what the MSCI did back then was, I think it was in the early 90s, they constructed an emerging markets index where they group them all together. And we take a very similar approach at ARK, right? We group some of these technologies together, especially those that are uncorrelated to one another. So we can get comfortable around that kind of excess volatility. And I think investors are starting to warm up to that as well. MSCI just launched a suite of innovation-based indices. So that may help investors kind of allow them to kind of monitor volatility. I think that's one thing. It's the fear of the unknown, right? But when you can actually watch it and see it historically, you get a little more comfortable because you can expect maybe an increased amount of volatility going forward, right? And we think as that asset class matures, right, you may see some of that volatility start to dampen.
I have to say, Ren, that was a very emotional period of time in my life back in preschool. I did get kept back that year. However, I did get picked first all the time in kickball, so that was the only thing that I look forward to. Speaking of emotions, and when we talk about volatility, what's interesting when people look at an ETF or they look at a certain stock and they notice the volatility in that stock or in that ETF, they never look at it as part of a portfolio. So talk a little bit about the non-correlated aspect of different stocks or different components of a portfolio and what that can mean over time. Because I think a lot of people don't get, if you put a portion of innovation into your portfolio, even though on its own it may look volatile, it actually does help the overall portfolio and smooths out some of the bumps.
Yes, I think that is a great point, Tom, right? No one is investing 100% in innovation, maybe Kathy, but the average investor is going to have, a broad allocation to many asset classes. And I think that innovation serves as one of those asset classes, right? And so when you look at it, yes, you're right. In isolation can be volatile, but because of that low correlation with those broader asset classes, whether you look at equity or even the non-traditional asset classes, whether it's real estate, even hedge funds or commodities, it has very low correlation. And so you get those benefits, right? We've seen that innovation has outperformed kind of over the last 5 years. And because of that lower correlation, when you're pairing that, it can actually bring down some of that downside risk that you have in your overall portfolio. So if we get another period, a bear market, right? We experienced a pretty significant shock as a result of the pandemic. We're starting to go through kind of this growth to value rotation. We could see kind of, a period of increased volatility. But what we've noticed that historically having your portfolio or exposure to innovation will help with that, right? And help you get through some of these difficult times, because innovation is all about solving problems, right? Innovation is around, building things cheaper, faster, more efficient. And it's in periods of turmoil where these companies, these innovative companies, are solving these problems and gaining market share. And I think that's what is key, right? So they may feel some pain in those earlier stages of a market sell-off, but they gain traction, they gain exposure and clients and new business, and they perform better coming out of those tougher times. And I think that's what's important to focus on. And that is really kind of the driving factor in having some exposure to that.
So Ren, what I'm hearing here is that you really can't approach any one of these ideas, any one of these innovation platforms, any one of the funds sort of in a vacuum. You really have to think about it all the way through that portfolio construction process so that you're figuring out how it helps the whole portfolio, not just the one thing you're investing in, right?
I think that's an excellent summary, Dave. So thank you, Dave and Tom. It's great seeing you. Looking forward to the next episode.